The IRS just dropped their brand new tax brackets for 2026, and this is huge news for millions of taxpayers. These changes mean you could pay less taxes on your next return. The new brackets let you report more income at lower tax rates. You also get a bigger standard deduction, which means less taxable income overall. For investors, this gets even better. You can now report more capital gains at lower tax rates. As someone who studies every tax change the IRS makes, I want to break this down in simple terms. We will cover the new brackets, deductions, and smart strategies you can use right away. Chapter number 1, why tax brackets matter more than you think. Most people get tax brackets completely wrong. They think if you are in the 22% bracket, all your income gets taxed at 22%. That is not how it works at all. Our tax system is progressive, which means different chunks of your income get taxed at different rates. Think of tax brackets like buckets. The first bucket gets filled with your lowest income and gets taxed at the lowest rate. Only when that bucket is full does income spill into the next bucket at a higher rate. This continues until all your income is placed in the right buckets. For example, a single person earning $100,000 does not pay 22% on the whole amount. The first $12,400 gets taxed at just 10%. The next chunk up to $50,400 gets taxed at 12%. Only the income above $50,400 starts getting hit with that 22% rate. This is why understanding the exact bracket amounts matters so much. When you know where these buckets start and end, you can make smarter decisions about your money. Now let's look at these new tax brackets and make sure you tell me in the comment section below what you think about these changes. Chapter number 2, the new tax brackets for 2026. Single taxpayers get some great news with the 2026 brackets. The income limits for each tax rate have gone up thanks to inflation adjustments. This means you can earn more money before jumping to the next tax rate. The 2026 tax rates range from 10% to 37%. But here's what really matters for most people. Your first $12,400 gets taxed at just 10%. Then income up to $50,400 gets the 12% rate. Income above that jumps to 22%. Now pay attention to the big jumps because this is where you can save the most money. The first major jump happens when you go from 12% to 22% at $50,400. That is a 10% increase, which costs you an extra $1,000 for every $10,000 in income above this point. The next big jump that gets expensive is from 24% to 32% when you earn $201,775. This 8% jump costs an extra $800 for every $10,000 in income above this level. This is usually when people start calling tax professionals for help. From there, your tax rates continue to climb based on your income up to the top rate of 37%, which kicks in at $640,600. But most people will never hit these highest rates, so focus on understanding where you land. Compared to the original 2025 baseline, these brackets let you fit about 2 to 3% more income into each level thanks to inflation adjustments. However, for married couples filing together, the numbers are very, very different. But real quick, if you don't know who I am, hey there, I'm Sean, a licensed tax professional who personally researches and writes every script you see from my clone. And before we move on, I wanted to tell you about an AI-powered software that I personally use to run my businesses, along with the software I recommend to other small businesses, and the sponsor of this video, High Level. High Level is basically everything you need to run your business in one platform. There's sales pipelines, marketing tools, website builders, email automations, workflows, and so much more. And recently, they've added new AI features that are absolutely insane. I'm talking about AI voice agents that can literally answer your phone and have full conversations with prospects and even book them into your calendar. There's AI chat agents that respond to every single message across all your platforms instantly. It's like having an AI employee that never sleeps, never takes a break, and never makes mistakes. And when you click the link down in the description below, you get access to a free trial, and by using my link, you also get an exclusive free 1-hour onboarding call with a high-level expert so you can get these AI systems set up immediately. And you'll get access to my new AI Business Blueprint course, breaking down how you can use this software to start and grow your business. So go ahead and click the first link down in the description below because you're gonna wanna see how this all works in action. All right, with that being said, let's get back into the next section of this video. Chapter number 3, new married filers tax brackets. Marriage brings some serious tax advantages that surprise many couples. Married filing jointly taxpayers get to use much wider tax brackets. In most cases, you can earn almost twice as much income while staying in the same tax bracket. Think about this for a moment. A married couple can earn over $100,000 and their highest tax rate is just 12%. That is an incredible deal and affects millions of families across the country. The same pattern continues up the income ladder. While a single person hits the expensive 32% bracket at $201,775, a married couple does not hit it until $403,550. That is almost exactly double, which shows the huge marriage tax benefit. Which brings us to the next new update. Chapter number 4, the standard deduction boost. About 90% of taxpayers use the standard deduction, so this change affects almost everyone. The standard deduction reduces your taxable income dollar for dollar, which saves you money based on your tax bracket. In 2026, the standard deduction increases to $16,100 for single filers. Head of household filers get $24,150. Married couples filing jointly get $32,200. These amounts represent the enhanced levels established under the One Big Beautiful Bill Act and continue with inflation adjustments. The higher standard deduction also affects people who itemize their deductions. Your itemized deductions now need to be even higher to beat the standard deduction. This makes itemizing less useful for many taxpayers. For most people, the standard deduction is the way to go. It is simple, and you do not need to keep track of receipts all year. Chapter number 5, capital gains tax rates get better too. If you invest in stocks, real estate, or other assets, these changes matter a lot. Capital gains happen when you sell an investment for more than you paid. The tax rate depends on how long you own the asset. Short-term capital gains apply to assets you own for less than 12 months. These get taxed as regular income using the tax brackets we just covered. Long-term capital gains apply to assets you owned for more than 12 months and get special lower tax rates. In 2026, long-term capital gains are taxed at 0% for single filers with taxable income up to $49,450. Married couples get the 0% rate up to $98,900 of taxable income. Above these amounts, the rate jumps to 15%. The 15% rate continues until single filers reach $545,500 of taxable income and married couples reach $613,700. Above these levels, all long-term capital gains get taxed at 20%. These income thresholds went up about 2 to 3% compared to 2025. This means more people qualify for the lower capital gains rates. Here is a real example of the savings. A married couple with $98,900 in taxable income who sells stock for a $3,000 gain pays zero capital gains tax in 2026. Understanding these brackets helps you time your investment sales. You might want to sell investments when your income is low to get the 0% rate. The IRS will also announce increases to retirement and HSA contribution limits, and I'll break down these changes as well, so make sure you are subscribed if you haven't already. All right, so that's the quick summary on new tax brackets for 2026. But there have been major tax law changes happening all year with the One Big Beautiful Bill. Coming up next, I have a video where I break down some of these massive changes, so check those out if you haven't already. As always, thanks for watching, and I'll see you in the next video.